Frank Kalinzi. I'm the head of Bancassurance at Pearl Bank Uganda, and within the position of head Bancassurance, the things we do is to ensure that we distribute insurance, life and non-life, to our customers. But the business we do called Bancassurance is defined as a partnership between an insurance company and a bank, where the bank sells the products of that insurance company to its customers. And these products are distributed through our branch network, through our digital channels. They are distributed over the counter and in all spans of the bank distribution, and we have been able to distribute these to our customers to ensure that we promote financial inclusion. There's been a negative perception about insurance compared to banking, that people believe insurers don't pay claims. And this is all in the narrative of there's always a devil in the detail when insurers are designing these contracts. That if you go back to the basics of law, insurance is a contract where the insurance company is offering terms and then the customer is accepting these terms. And now the gap of where there's information asymmetry is in between when the claim happens. Many claims have been repudiated because customers didn't understand that onset. And when these are declined, it brings in a public general negative perception about the service, and this has been a clear barrier. The other barrier to insurance penetration is, I think, limited distribution of insurance services. You find that most insurance companies they are concentrating within the CBD, major cities, and then if you look at the numbers based on the population, the recent population census, so many Ugandans with incomes are within rural areas. These are farmers with money. But again, insurers have failed to penetrate the deeper areas compared to banking. So with that, you'll find that again, you cannot sell to the CBD customers and then you expect the penetration level to grow. Because to get the penetration rate, you have to compare the premiums, the gross written premium compared to the GDP. And now you're targeting CBD people, and yet you want to grow the penetration rate. So insurers have actually concentrated in urban areas, and I believe this has also affected penetration.
So Pearl Bank could change that with all your branches?
Yeah, with all our branches spread all over the country, and already we are doing this. You'll find that in Kotido, someone will get a motor policy, someone is able to get a medical policy in Moroto, and that is actually going to change the narrative. The other issue is limited incomes. You'll find that premiums that are brought to our customers are quite high, and if you look at the disposable income of an average Ugandan, someone to come and buy a motor policy with premiums of 2 million, this is an hindrance to uptake. So as we look at people getting policies, penetration increasing, we are trying also to measure it against the average GDP, the average disposable income of a Ugandan. And as incomes grow, we are moving to the middle stage. We believe more people buy these policies. And then I think the other issue is limited financial and insurance knowledge. You'll find that many Ugandans are unable to understand the jargons, the insurance language, the terms and conditions that are within these policies compared to a bank product. If I want a loan, it will be as simple as getting a key fact, and I know that this is an agric loan, this is a salary loan. But if someone is selling insurance, there are terms like subrogation, excess, deductible, and I believe these detailed jargons, insurance language, it is also breaking. It's a barrier for people too, because you cannot buy what you don't know. And I believe with those, if those are tackled within the bancassurance span, changing the narrative, changing the language, making it simple, we are going to have penetration improve. From 2017, when the Insurance Regulatory Authority and the government of Uganda brought in the regulations that allow banks to distribute insurance, we've seen numbers grow. There's been an exponential growth in gross written premium, and I believe some of the things that have been done to change the way things are, one of it is embedding insurance in the bank transactions. You'll find that predominant insurers wanted to distribute insurance using agents, brokers who move door to door, selling these things to customers. And at the point of selling, you'll find that if I want to pitch Paul at New Vision, he's also busy. He's unable to buy insurance. There's no time for him to discuss with me to buy a policy. But now, because banks already have data back in, they can see transaction history, you can see life trends. An example, if I've wedded, they'll understand in the bank that now this is a person who is having a family, meaning I can get a medical cover. If I am doing a lot of consumption using my card, they are going to know that I either manage an eye customer and I need travel insurance, I need wallet guard. So banks are trying to use the transaction history and the data they have to design products that are embedded within at account opening. At the point when I'm getting a loan, I can get a mortgage life. So meaning banks are able to integrate insurance products that you can actually consume when you have actually not bought them, but they are embedded within your bank transactions. The other issue is digitization. Unlike insurers, banks have innovated bancassurance systems that are able to sell to you products over your phone. For the case of Pearl Bank, I'll give an example. If someone goes to the Pearl app, you can initiate and you get a trigger where we ask you data. And if you give us data that you own a vehicle, you'll give us a value of that vehicle, and you automatically get an online auto-rated quotation. You don't need to see a physical Franks pitching to you, but you can get different quotations from our partners, having visited our app. We are under discussions with the insurers to ensure that we do micro life insurance and funeral covers on OND. So imagine someone in Soroti, a member of the VSLA that is on our OND platform, and they automatically get a funeral benefit just because they are transacting on OND. And how easy is this? We are able to collect premium from your OND mobile wallet, remit it to the insurance company. Same time when we get a claim, it's just transferring that money from the suspense to your OND wallet. And this is because we are able to reach you. The mobile wallet it's just a click. You download the app, you start transacting, we see your transaction history, we generate a funeral or life benefit for you on the OND. So banks are more ahead with digitization and innovation, and we are able to change the narrative, and we believe we are going to get masses. Because with mobile wallets and digitization, you can sell to some people who are actually far away, even those who are in hard-to-reach areas. And I believe this is not something insurers are given attention to, and we believe if we push it harder, we are going to exponentially grow premium numbers. I can be clear here that it's actually, we are really competing. The competition is stiff with brokers. Ever since bancassurance came in the space, and brokers are clearly aware, we've seen brokers also coming up with innovations, because you see with banks, immediately they looked at this as potential business. The discussions are heavy in the boardrooms on how to really grow bancassurance, because it is a space that there was bread on the table and everyone was easy to get it, but now we really want to make it hard to get that bread on the table. And the others are finding it hard to get it because we are really pushing harder to make it scarce on the table. And like we are in the banking space, I can say previously, general insurance, which is short-term, motor, fire, used to be the insurance that people buy, because maybe for your information, insurance is sold, not bought. So few people would come to buy policies. Either you are getting a loan and you want a fire policy, you are getting a mortgage, you want a mortgage life, and maybe you're having a contract and they tell you we want your workers insured. So previously, before I joined the bank, we used to get people, NGOs coming in to buy. But now with the introduction of bancassurance, I've seen endowment covers like the period you save, you see the Investor Plus, the Somesa Plus with Old Mutual. These are life insurance policies that run for a period of time, maybe minimum 5 years, and they combine what we call saving, investment, and protection. So banks used to promise customers that when you bring your money here, you are saving it, we shall give you a return. So with competition, you find that traditional banking needed to sell something different. So if you give me safe custody for my money with a minimal return, how about my life? So they said the only way we can sell a life benefit is to introduce life insurance. And if you look at the past 7 years, there's been an exponential growth in life insurance, individual life insurance, where you come and we package for you a plan that in 5 years you are going to have a sum assured of this. But in case you die, your family will get a death benefit, premium will stop being paid, but they also get the other guaranteed sum assured. So with that, when customers learned of that, they said, okay, if I have my money, at times even banks used to have what we call dormant accounts with money. So the only way we can reactivate dormant accounts, we tell you, come, you have 10 million, we can churn it to insurance. At maturity, you get this. But in case you die, so there's been an exponential growth of endowment covers. These are individual life products that guarantee you a return. They guarantee you a sum assured at maturity, but also your life is protected that in case of death, your dependents or next of kin has something to take. And with the black tax we have all over, many people are looking at that as a way, as a proposition that the bank is bringing on board. Rather than saying we have safe custody, we shall keep your money. So I think endowment is one of them. The other one is medical. So medical insurance, many people confuse it with life insurance, but medical is real-time consumer insurance, that is health insurance. In case you are hospitalized, in case you're sick, sickness cover. And you'll find that the traditional medical insurance, it was have a premium cover. You have to pay to get a card. You pay 5 million, pay 10 million for a family of 5, family of 4. So it was quite expensive. But you saw when we started Bancassurance and banks looked at the nature of your transactions. We have what we call hospital cash. So hospital cash, Frank walks into a bank, I get a loan, charge me a minimum premium, but when I'm inpatient in hospital, something will be paid to me per day I spend in the hospital. That was an innovation. We saw that instead of the other traditional walk in, be checked, pay a card, switch it off, then deduct the money, here you just get a benefit. It's called hospital cash. So the money you've spent in the hospital on your bills and a few expenses will be reimbursed back to you. And this is something our loans customers are taking on because they used to give an excuse. I can't pay your installment because I used the money to pay for medical bills. Then we shall say, but you got a benefit from an insurance company for hospital cash. So that is also growing because it's embedded within the loan products. There is no way Frank will give you an excuse that this time I'm defaulting on the installment because I was in hospital, and medical bills are genuine bills. So if I was in hospital, I won't pay. So we are also seeing that as a component of medical insurance, but also from grouping medical insurance that companies give, we are seeing insurers giving family medical covers that are well priced. And these covers are helping many Ugandans. Rather than picking from your pocket, you'd rather present a card at the hospital and you get treated. Yeah, so it's mainly endowment and medical, because these are things that were not there before. So they were there, but they were not distributed well before Bancassurance. Maybe there's something I didn't mention. If you look at the returns of 2025 December, the combined figure of Bancassurance, PAL Bank, combining life and non-life, were position number 6.
What 5?
Number 6 combining, well, number 5 general, but combining life and non-life became number 6. And number 6, that means we're in the top tier of the banks that are distributing life and non-life. And one of the reasons why we do that is management embraced this business not as a form of non-funded revenue, but as a bank that wants to make Uganda grow and prosper. We believe we are supposed to be a one-stop shop for all financial services. So if you go to a branch in Masaka, you'll get every product of insurance you want. And the reason is we want someone in Masaka to get an agri insurance policy, to get a funeral policy rather than walking to Kampala. So that position we are up compared to other banks. It's because we are distributing much more of these products and we have negotiated quite affordable premiums because we know we're a mass market bank. First of all, I'm quite very passionate about the industry, the insurance industry. I try to look at it. For the span of 15 years I've been in this industry, I've seen that we have been having a challenge of innovation. Traditional insurers want to play in this. Their pie is the same pie year on year. But I believe there is a lot of innovation I'm foreseeing compared to what the region and the global market is at. I foresee a lot of micro-insurance happening in our space. Because if you look at an average Ugandan, they would want to buy insurance, not at a micro level compared to these commercial covers that we are churning out, based on their disposable income. So I see micro-insurance growing at a faster pace compared to the general insurance we've been doing. The other issue is, if I would compare with our neighbor Kenya, which is quite ahead of us in penetration, for insurance to grow, I foresee insurtechs coming into this market. And like you've seen fintechs giving banks the run for their money, I see insurtechs coming in. And I'll give an example. If you look at a company like Turaco is a micro-insurance company. Comes with minimal premiums, embedding them into circles, embedding them into bank products. And if you look at the numbers, they're enormous. So at the same time with the insurtechs, we are having an issue that insurance products are done, we are doing transactions manually. So if an insurtech comes in and they are providing a system, a platform, where numbers are going to grow, you provide a system and then automatically that system is reaching so many people. So I've seen insurtechs working well in South Africa, some are in Kenya and in Europe. If insurtechs come in, we are going to see exponential growth in numbers because the same thing you've seen fintechs vis-a-vis core banking, trying to grow the business at that space at which level. So micro insurers and fintechs are the game changers of the insurance business in the medium term. From the basics, you'll find that if we are to define the functions of a financial sector, any financial sector, there are three core functions of the financial sector. That is saving and investment, payment systems, insurance and risk management. So the third function of insurance and risk management, I'm going to concentrate on insurance. And you said the first sector is agriculture. So first of all, our country is a predominant agri country. And everything we do, the sector that we believe that can be the benchmark of everything is agri. And insurance as a means of risk transfer, safety net. There is a lot that is being done in the background to ensure that insurance is supporting the agri sector. One, the government of Uganda a few years back went into a private-public partnership where Minister of Finance, the Insurance Regulatory Authority, and the Uganda Insurers Association created a consortium of insurers called the Agriculture Insurance Consortium. So the Agriculture Insurance Consortium has a consortium of insurers that insure agriculture. And we are well aware that agriculture is prone to catastrophes like drought, floods, and so many. So what the government did is they went into a PPP, public-private partnership, and decided to subsidize insurance premiums for agriculture. And these are based on different regions. You'll find that in the Karamoja region, the subsidy is up to 80%. The government pays 80%, the farmer will pay 20%. If you come to maybe Buganda region, it's 50%, the customer pays 50%. And there's a bank that is championing agriculture credit facility. We are champion in distributing the agriculture credit, the agriculture insurance consortium facility. This is embedded within our loans. That if you borrow and you're taking a loan and we are insuring the loan for your death, we actually hinge on the agriculture insurance rate. And then we shall also claim the subsidy from the Ministry of Finance. So government has already started that. And all that is to ensure that there's a subsidy, they are trying to encourage the average Ugandan to come with the other percentage of the subsidy to ensure that you are protected from these droughts. And I can give an example. Just this year, we have paid over 1.8 billion losses, droughts in Mwende, Kapchorwa. These are floods that happen, and in case they happen, farms are assessed and we pay claims. So automatically in the space of insurance, there is already a public-private partnership between government and a consortium of insurers to ensure that farmers buy insurance at a subsidized rate. We are also under discussions with I think there's UNF something, where we are trying to again get them as private partners to come and add on the subsidy, because we just want to encourage the farmers to insure. But again, even when they don't borrow, we have big commercial farmers like Region in the north who have taken on these policies. These policies are designed for weather index insurance that in change. We are working with the meteorology. They are also what we call yield index insurance. So when I talk of weather, that's where you see perils like droughts, floods. Yield, you've planted your things, but because of weather changes again, the yield goes down. So again, we have to indemnify you for yield loss. So the details are there, and I think today at 11:30, there's a donor coming in here. We are going to discuss on how we are doing that insurance for farmers. I used an example of Region, but that's a commercial farmer who goes now and he gets his own farm policy. Says if I grow crops this year and there's a challenge with weather and yield is down, he gets what we call a yield index cover. But he can also say, I want a weather index. If we plant today and rains delay to come, and now they come, maybe they come, there's drought, and it is known, because this is catastrophic cover, the insurance company will come and pay me the equivalent of what I would have harvested. They send planting seasons, so you can't plant past the season. That means you've done late planting, so you are outside the policy. You get it? But also to claim, they will confirm that there was a drought in Camden, or there was a drought in the cattle corridor. So when it's confirmed, because to confirm a catastrophe, it has to be 3+1 homes confirming. You can't say there was a flood at Frank's home and it wasn't at Paul. So you can't say there was a drought in Masaka, but it was within 3 homes. So they'll confirm 3+, and then the meteorology department will say that in this area we confirm a drought. So whichever farmer that comes with that area and they say we really had drought losses, we assess and pay. Okay, it's 50-50, but it's spread over. You see, you'll find that there are areas that are really prone. So I can say 80% can be Karamoja region, because you're aware there are challenges of weather. And then they will say in the central and maybe western, it's 50-50. So if the rate is 5%, so you pay 2.5%, the government will remit the 2.5% to the insurance company within that consortium. So there's an MOU between the Minister of Finance, the insurance consortium, and maybe let me say now the customer. Now the customer this time round is Pearl Bank, because we have a big channel of borrowers or customers who we present to them. So the contract is always between the customer, the insurance company, and the government under private-public partnership. Truth is, banks already have trust with their customers, and the depth of trust at the bank, on the bank side compared to insurance, there's a big gap. Because previously, more so for Uganda, we had a trust gap. I think Paul will tell you, those devaluation time, people who had life insurance policies, money. I think in some years back, there was devaluation. Truth is, there was change in value for money. People had life insurance policies. Some of the trust challenges are historical problems that happened in this country, and people lost trust. Because if you had a policy with a sum assured of 10 million, a zero is deducted, somehow it was. So you find people are discouraging their children from buying policies because of what happened before. But also the claims experience. If you look at the past 15 years, and I keep telling someone that the industry had the challenge of talent. That if you look at most big brains are concentrated in banking, and now we had a few people who looked at this business as business. Why? Because everyone would know that it's at the mercy of the insurer to pay a claim. and yet the insurance has a clear principle of utmost good faith. So customers lost a lot of trust in insurers, and now with bancassurance, safe custody in a bank already set trust, a lot of belief in the banks that my money has been here safe custody. Insurers are hinging on that trust to drive penetration. Because even as we sell policies here, the customer will tell you that this is a product of Old Mutual. Where is Pearl Bank co-branded? Why is the KFD for Old Mutual? So we sat with the regulator and they have allowed us to co-brand these KFDs to ensure that the proposal forms that we are filling are co-branded, because someone says, I really want to put all my feet in the basket of Pearl Bank. That at claim time, you are the guys I'm looking at. So this already preset trust is going to be a big pillar in ensuring that people start believing in insurance products the same way they have believed in the bank products. And we are going to hang on that to ensure that we sell these products, we honor the promises, and the truth is the bank stands on the side of the customer. If there's any issue, the bank is standing on the side of the customer, because there is what we call an agent of the customer, agent of an insurer, but when we are getting the license, we are agents of the customer. That's why we are only supposed to sell to Pearl Bank customers. So if you came today and you want to buy a policy, you are not our account holder, I'll first request you to open an account. Why? I am the agent of a Pearl Bank customer. And it's based on that trust that you have with your banker that you will actually believe that I'm going to be paid and shall ensure you are paid. Any business that is done in this country, there is a law of the land that governs it. So for banks to do insurance, we base first of all on the Insurance Act. This country has an Insurance Act, Insurance Act 2017. But again, within that act, there came the regulations, the Bancassurance, the Insurance Bancassurance Regulation 2017. So those two laws are clear about consumer protection. But I think on my side, I believe there's what people always interpret law differently. Sometimes people interpret it to take advantage of it. But I believe with those laws clearly interpreted by the banks, the customers, and the legal representatives of these customers, I believe the customers are in safer hands. These are laws that have been benchmarked globally and within the region. And there is also the Insurance Regulatory Authority that is overseeing everything we do. That regulatory authority has an issue, customer complaints, online customer complaints portal, and cases are heard. There is actually, you can appeal these cases to appeals tribunal. There is an insurance appeals tribunal. So to any Ugandan out there, they should know that there is oversight about the business we do, and people have lodged informal complaints. These have moved up to the tribunal. After leaving the complaints panel, the tribunal is headed by a judge of the Court of Uganda, and cases have been heard, compensations have been done. So whoever does not believe that there is oversight, there is consumer protection, there is the law of the land that governs the business we do, it has oversight with the regulatory authority. The central bank has an interest, Bank of Uganda, in the business we do, because we are doing it within the bank. They also come and see, are we doing it for the customer? Are we doing it for the insurer? Are customers protected when they are taking on these policies? I can confirm that customers are protected. Whatever that is within the policy is for the good of the customer, and we've reviewed it. Yeah. So Pearl Bank, and like someone was saying, being an indigenous bank, truth is, we've seen a lot changing in the span of the bank we are working for. And our belief is we want to have an indigenous bank that we all believe in. And I can say to everyone here that all countries that have grown economies, you'll find that the indigenous companies, banks, insurance companies, and I will say Kenya, KCB, NCBA, these are indigenous entities. And for us as employees of this bank, we are trying to make ourselves believe from top management that this is the journey we are on. And we've worked with insurance companies, and this is what we are seeing. Bancassurance as a distribution channel within this bank, staff have bought into this idea. Not for what is in it for them, but what do we do for a customer to change their life? And in that process, insurance companies have set up challenges. Like any business, they come in with sweeteners that if you do this, we shall do this. We've been winning year on year. For myself and colleagues, we've traveled to Cape Town to see how business is done by Old Mutual. This same month, a team of, I think, 2 staff are moving to Zanzibar, taken by Old Mutual, just because they have been able to push the numbers in terms of gross written premium challenge, and these are awards they win. Tomorrow, same, I think at around 8, the CEO of Isaiah Life Insurance Company is coming in at flag off 2 staff who are traveling to China for a fully paid trip for a full week to experience how insurance is done in Shanghai, just because we were able to meet the premium targets they set. And one of the things we are doing to ensure that people buy it, because we said the insurance is sold, not bought, how do you make the person who is called the lead generator, core banking staff, cross-sell insurance vis-a-vis selling other products? These are some of the sweeteners that come in. The bank has internal awards, but also insurance companies being partners, they come in with such promos. And these promotions are throughout the industry. Some banks that are strategically pushing this win, some don't, but we've been winning year on year just because we believe that we can sell insurance with the purpose of driving financial inclusion and growing and prospering Ugandans. If I compare, I may not have the actual statistic, but I may know the number vis-a-vis. Let me say 2025. 2025, we did close to 2.2 billion commission revenue, and the bank did around 47.9 billion profit after tax. And commission revenue is non-funded income. It's pure fee money. We don't provide for anything. And if you compare to the industry, the biggest bank that combined commission, I think, was around 10 billion. And for us to look at commission, comparing it, like Paul said, to the brokers, a broking team, like let me say Marsh, they can write commissions of around 3 billion. So this is more like a broker within a bank. So if we compare the ratios of 2 billion vis-a-vis 4. We are quite a cash cow if we are looking at our estimates and the forecasts we've done. Because if we are planning that if we hit 1 billion commission revenue, we want to be an independent part of the bank. Like, I'll give an example. If you go to Kenya, Equity Bank has an independent arm, Bancassurance intermediary, separate board, because here now you want to really look at business, separate. And then in Kenya, banks like KCB, Equity, they have separated Bancassurance, because here now you strategize for it as separate business. And I can tell you, immediately we receive
something that is coming.
It's something we see, because if you look at the forecast, 2019, we did around 100 and something million commission revenue, and we are now at 2 billion. We anticipate doing 3 billion this year. So if the growth trend stays like that, we see in a short span of time, if you can earn commission fee income of 10 billion, this is money you're not providing for, hits your P&L directly. Then you can separate that business and you say, let's watch it as a separate business. And immediately you do other things. You know that after funded income, after the competition we are having, because core banking is competitive, same interest rates, charges. So you are looking at now for non-funded income, and it's a big portion of non-funded income in this bank strategy. That if we can have this money, clean money down here, let's say 20 billion, as you're computing, providing at the end of the year to get profit after tax, you know we have already money in the pocket under Bancassurance. So the truth is the trend has been positive, year-on-year growth. And there's the other issue, Paul, people don't look at, the claims bit. So Bancassurance has 2 advantages, it's a profit and service center. So we get over, like I would say last year, if you look at the statistics, over 9 billion claims paid dead customers were passed on.
9 million in value.
9 billion value of loans that would have gone bad. So again, as we look at provisions, these are monies that come in and post and pay off. Guy has passed on. Money that come in, someone at the farm, it got an issue, he would have been a non-performing asset, but we pay. So for me, if I'm augmenting and looking at my value in the bank, I'll combine the claims money with commission, because this is all money that will affect the bank's balance sheet and income statement. Before bancassurance, there would be not much of that revenue, but also the money that comes in as a claim. So whatever we are discussing with the team, I tell them we're a service center and a profit center. So if we don't service on claims, the bank is going to have non-performing assets and they'll provide for them, touching profitability.